the best thing about this quarter is the fact that, despite some of those price increases, our transactions were up 4%. And that tells us that customers still think of Chipotle as the meal that they want to eat at a great value.
You may not be able to go out and get a new car. You may not be able to go out and get a really fancy piece of technology, but you can afford a bag of Doritos or you can afford a Gatorade Zero after you work out. We tend to do pretty well through times when the consumer is more stressed on a macro basis because we are a simple treat in your life that makes you happy.
So as we just heard, shoppers are still paying up for food despite price hikes, say Chipotle and PepsiCo CFOs. But just how far can companies hike prices before customers have had enough? Peter Galbo is Bank of America's food and beverage analyst. He's joining me now to break down the limits of pricing power. So, Peter, how do we even go about answering these questions, right? I guess these companies are going to keep raising until consumers push back?
Hey, Julie, good morning. Yeah, thanks for having me. Look, I think at this point, what we're noticing is most of these companies are talking about the fact that they've taken the pricing they need at this point to cover their cost inflation for the better part of the year. And really, the pricing that you're seeing come through, whether it be Coke or McDonald's, is really pricing that had been put in place during the fall and during parts of last year, something that we refer to as wraparound pricing that's now carrying through the first part of this year. We'd expect that to kind of dissipate as we go forward.
I mean, it might dissipate going forward, but it's not like these companies are going to roll back the price hikes, right? I mean, they've raised the prices. They're still going to be, higher than they were. It's just the people, I guess, are adjusted to it now.
Yeah, I think that's right. What we're expecting is that as you get kind of towards the second half of this year and into the fall, you should see that pricing contribution really moderate pretty significantly, almost to a flattish type basis. And then from there, particularly around the food companies, it's going to be a story of kind of where the volumes can recover on the other end. I'd agree with your statement. We're not expecting large-scale price rollbacks, but I do think what you might start to see as these companies try to kind of recover some of that volume that they have seen fall off is a little bit more merchandising, potentially a little bit more promotion, particularly around some of the big holidays.
And then I guess the other question is, we were looking at PPI earlier today to try to figure out where costs are going up, where they're coming down. And there's definitely not up arrows across the board, right? Like there was maybe a year ago. And although we're still seeing sort of persistent labor inflation to some extent, I guess my question is, at some point, are we going to really see an inflection point for margins if pricing is remaining where it is, but a lot of those input costs are falling?
Yeah, we've started to see that, particularly out of some of the food companies and even out of some of the beverage companies, where the gross margins kind of have started to recover back to some of those 2019 type levels. Now, what's interesting from here, particularly on the food side, is you do have some of these categories that are more pass-through in nature. And so if you think about the underlying commodity and the impact that has on the shelf price, as that commodity cost comes down, typically the companies tend to pass that pricing back through, at least at retail and on the shelf. We think about that as, items you might buy at the store that have very few ingredients, very simple in nature. And so, the retailers can really look at the underlying cost and say, hey, where can we help the consumer? I think about that in categories, like coffee and like bacon. And we're even starting to see that, show up in the data.
And so who in your coverage universe do you think is poised to benefit the most this year from those changing trends?
Yeah, I think from a cost standpoint, where we're seeing a lot of that deflation or disinflation, it's probably going to be more on the food side. They just have more exposure to some of the agricultural companies. We think about that like a Lamb Weston, which is the largest French fry manufacturer in the U.S., obviously a big supplier to McDonald's. They're still seeing parts of their cost basket that are inflating pretty materially, particularly on the potato side, but they are starting to get at least a little bit of relief on some other elements like cooking oils, freight, and some of the energy costs.
It's pretty astonishing to see a food company like Lamb Weston, frozen French fries and tater tots and whatnot, have a 24% increase for year to date. I mean, are any of these guys, in anticipation of all this, are any of them getting pricey? What are we seeing in terms of valuations?
Yeah, and Lamb Weston is a pretty unique company within our coverage. So again, more of a food service bend versus, say, a Smucker's or a Campbell. About 85% of their sales come from restaurants. The potato industry has gone through a tremendous upheaval in the past few years, just given the crop that's happened in parts of Washington and Idaho here in the U.S. We've really had some idiosyncratic issues. But what I do think is, fries are an indulgent category. Capacity is very tight. Think about it like chocolate or coffee. It's something that we're not really willing to give up. And so you've seen that pricing power come through, and even as McDonald's mentioned yesterday, the traffic has still been very good.
Yeah, definitely. All right. Thanks so much, Peter. Great to get your perspective on this. Peter Galbo is Bank of America food and beverage analyst. Appreciate it.